August 24th, 2023. Today was an outside down day. You can see we started out above yesterday's high and ended below yesterday's low. And 70% of outside down days close in their lower third. So you can go back and run this on any day that was outside down. And it holds the same for outside up days as well. 70% of the time it's going to close in the lower third on outside down days. And on outside up days, 70% of the time it's going to close in the upper third. The prior day's low is almost on outside down days. The prior day's low is almost always support. You can see here, we basically went to yesterday's low. We tried to break out below it on 30, and bears wanted to get consecutive closes below yesterday's low, 30 and maybe 31. But on 30, they failed and bulls bought it because yesterday's low is always going to be support, and that was the start of the correction. There's also a leg one, leg two measured move. If you go from bar 7 and to bar 13, that was like the big spike essentially of the day. Then you put that on top of 15, it was exactly a leg one, leg two measured move down to 31. So the height of this, usually when you get a spike, it's strong enough for a second leg. And sometimes that second leg will be, a whole full measured move down, like somewhere down here. But today it just ended up being a leg one equals leg two measured move. And something else to keep in mind is the bulls tried to create a bull flag somewhere in here, and they tried to get a breakout up, basically trying to force a trading range. A lot of times when you get a bear channel on the open, it'll turn into a trading range. But they were unable to do so. So we ended up getting a measured move down of the bull flag after bulls failed. So bulls failed to get the bull flag, and we broke out below it. And when you break out below a bull flag, there's at least a 40% chance that you're going to get a measured move down of said bull flag. So maybe some traders will sell 71, hoping for a measured move down, but that seems really unlikely with how little time there was left in the day. So it would have been hard to trade that one and make money on it, but it's just important to note. Something that's more important to note is that bars like bar 41, so you get to a wedge up to the moving average, and when you get, essentially it's micro double top flag at the moving bear flag at the moving average after the spike, you have about a 40% chance of getting a measured move down to here. So some traders will sell and just hope we get down here, which we did. And you can see you're getting like 5 or 6 to 1 on your money. So, and with a 40% chance, that's a pretty good trade. But the problem is, it's hard to hold through like bar 54 because that's a potential major trend reversal. For bar 50, kind of hard to hold above that too. And so a lot of traders will just scalp out when we get back to the new low, because there's probably like 50% chance, maybe 60% chance that we get back to this low. I'd say it's probably 50. And so when they get there, they'll just scalp out. And, 50% trade, your risk is, like 6-ish points. Your reward is 11.5 points. You're getting almost 2 to 1 at 50%. So that's a good trade as well. So the day started. Something that's important to note is yesterday was, bull trend. And then we got a trend line break. And the gap up essentially was an overshoot and a higher high major trend reversal. And so there's a reasonable chance of a major trend reversal. The same way that this was a bear channel and we broke the trend line, the same way that this broke the trend line. And then we tested back to the extreme, the same way we tested past the extreme up here. But sometimes it's a higher high, sometimes it's a lower high, it just kind of depends. And we tested the extreme almost exactly. We tried to get a major trend reversal on bar 50 and 54, but the bulls failed. But anyways, today, bar 1, gap up, big bear bar closing near its low. It's a big bar, so big risk. So I wouldn't take the short. It's most likely that we're going to continue sideways, or since yesterday was such a strong bull trend day. Something to note is after strong bull trend days, there's a 75% chance of 2 hours of sideways to down trading. So you got to keep that in mind. It's probably not going to be a bull trend day. Bar 2, bad follow through for the bulls, probably still, or for the bears, probably still more sideways. Bar 3 is another bear bar, but look at how pretty consistent the selling was here. The bars were roughly the same size. There were some tails, but after the breakout, the bars stayed generally the same size, and these pullbacks were small. The selling was consistent. That's what you want to see in bear trends. These bars all pretty consistently sized. So when you get a big bar, doji bar, small bar, it's harder to want to sell. You have to keep in mind there's also an 80% chance you're going to get a minor reversal on the open. So there's an 80% chance we're going to at least get an attempt at a bull move. So it's really hard to want to sell down here. And that's why a lot of traders don't sell. And we get bar 4, bears buying back shorts, below 3, bulls buying below 3, betting it's not going to go anywhere. Bar 5, big bull bar closing near its high, but I suspect the bulls will be disappointed with the follow through. It's a trading range, so bulls are probably going to be disappointed with the follow through. Bears are probably going to be disappointed with follow through. And then we got bar 6. I think bar 6 was interesting because you had bull bears who sold above bar 4, who theoretically should get out of break even, but they might be trapped on 6. But 6 doesn't close above 1. If 6 closes above 1, I think it's a credible buy. But the problem with 6 is that, we're probably in a trading range, and so the pullback could be a lot deeper than you want it to be. And this is a great example of that, when that can happen. And it's the same thing for the bears here who are selling down here. The problem is the pullback can be a lot deeper than you want it to be, like it was here. And if you're a bear and you're selling down here, where's your stop? Probably right here. And trading ranges love to just go stop you out and then go in the direction that you what is going on with my mouse right now? And then just go in the direction that you initially thought that they were going to go. And you can see that's pretty much exactly what happened. All right, my mouse is being screwy. Hold on, I'm going to pause the video. Okay, so when we got the breakout on bar 7, or at least the attempted breakout, you could see that bulls didn't buy it and it failed. And anyone who bought above 6 was looking for another bar like 6 on 7. 3 bars would have confirmed for the bulls that this was probably going to be a breakout, and they didn't get that third bar. And so we ended up getting a failure, and any bulls who were long above 6 just sold at the market and caused 8. And it was a big bear bar closing near its low. You could potentially sell below 8 for a swing. I don't think it's that bad. It's early in the day, so it's reasonable to take those shorts, hoping you get, 2 to 3 times your risk, which in this case you did. But you want reasonable follow through. If you start to get bad follow through, you got to get out, because the bar 7 low is going to be a magnet. So you have to be very careful. 9, follow through for the bears. It's not ideal, but it's still follow through. And then you get bar 10, which is follow through as well. 11 is more bear follow through, but did trade above, and it was a potential second leg trap. But you just kind of have to look at this and realize that it's, what's the always in? It's always in short. What part of the market cycle are we in? Are we in a breakout, a tight channel, a broad channel, or are we in a trading range? We're in a breakout, essentially, a breakout and a tight channel. You could argue that 8 was the breakout phase, and now we're in the tight channel. But regardless, if we're always in short and we're in a tight channel or a breakout, it's still a sell to close market. So you need to be selling. Just sell for any reason, sell any bear bars, and just hold until there's a reason to get out, until the market flips to always in long. More follow through on 12. So you have four straight bear bars, and 5 straight bear bars. Technically 6 straight bear closes, but 5 straight reasonable bear bars. So you're probably going to get a measured move. And then bar 13 breaks out of the channel line. And a lot of times in these situations, you kind of think that, it breaks out and you're expecting a pullback. It's something I do a lot, try not to as much anymore. But, I know there's going to be a pullback, and then I'll just exit at the market thinking that the market's going to pull back, but I can't get back in properly. And so when it does pull back, I'm not wrong about that fact that it's probably going to pull back, but it just makes more sense to sit through the pullbacks than it does to, scalp out, because I can't get back in properly. Unless you're a really, really good trader, it's really hard to do. So it makes more sense to just sit through the pullbacks until you get, the always insta flip like it does down here. Once you get, you hit yesterday's low, which is a reasonable profit target, and 32 starts to race up, probably just, on the close of 32, 32 is enough for a second leg for the bulls. And that's the first time bulls have had a strong enough move for a second leg since 5 and 6. So you can just exit the market on 32. 15, bear bar closing near its low. Some follow through on 16, but the bulls who bought below 14 are probably going to make money. And you can see the bulls who bought below 14 do make money on bar 17. 15 and 16 is enough for its own second leg, so bulls aren't going to buy above 17. That this is really strong, and bulls aren't making money in this. You can see bulls who bought below 4 got trapped, not able to make money. If you bought below 10 even, you got trapped and weren't able to make money on 12. There's one tick gap there. The high is 44.25. The low is 44.5. So bulls able to make money here tells you that this is a slightly weaker bear channel. Now, instead of a breakout phase, now we're in a tight bear channel. 18, outside down. It's a bear bar closing near its low. It's a reasonable swing short. Follow through on 19. 19 does break out of the channel line. You can see we have a channel line here, essentially like this, and it overshot it by a little bit. And so, it's okay to just take partial profits. I guess at that time it wasn't quite that steep. You could argue that it was this and that overshot it, but once it got less steep, you can see here. So once we got that, essentially the overshoot, it got less steep, and then it turned into a trading range. And that's kind of what happens with these. This is unusual. This doesn't usually happen, but today it did. So 19 bear bar, but a lot of buying pressure. Probably going to pull back soon. 20 buying pressure. 21 doji. Bulls are trying to see if we can get back to the 16 and 17 low. The reason is they bought there and they're buying more lower, hoping we're going to get back to that breakout point. But if they made money here, so they're going to buy again at the new low. But we'll see if they're able to make money. And you can see that we got bar 22, bad follow through for the bulls on the micro double bottom. 23 inside bar, so it's kind of an II. It's not technically, but it kind of is going to trade the same way. And then bad follow through for the bears on 24, and it's reasonable to get out of shorts above 24, but it never triggers. So you get an inside bear bar on 25. Bears know it's reasonable to get out of shorts above 24, and they don't want it to trigger. So they basically just sold the market immediately when 24 closed, and that caused a big bear bar on 25. Some bears sell below 25 and get follow through 26. And by the time you get 26, it's pretty climactic, but it's also pretty clear that we're probably going to get to yesterday's low, and we're probably going to make this an outside down day. 27, not the best follow through for those bears, but you can see we end up getting there on 29 and 30. But these pairs of bear bars getting pretty climactic. This is pretty overdone. And then bears start buying back shorts on 31, below 30. And then bears know that yesterday's low is support, so they buy back shorts in a hurry, causing 32, 33. The trading range probably started at 24. Sometimes that'll happen where you get the bears will sell this close, but they know that this was enough strength for the bulls to convince the bulls that, even if we do go lower, they can probably buy lower and make money. And so when we start to get back up here, any bulls who are buying up here are probably going to sell out around break even. It's also the top of a sell climax, 24, 25, 26. So that we might turn down from here. Additionally, we have a lot of bars below the moving average. So bears will take the first sell at the moving average, the first attempt to sell at the moving average. And they know that there's, like I said earlier, probably a 50% chance they're going to get down here, maybe 60% chance they're going to get down here, and a 40% chance if the Med would move. It was important for bulls to try to put a close fully above the moving average, a bull bar closing near its high fully above the moving average to show strength. And you can see this wasn't fully above the moving average. It didn't close near its high. And they were just unable to do that all day. The moving average kept, bears continuously sold the moving average. And so 40, this ended up being a wedge. So it's one push, two pushes, three pushes. And 41 is a reasonable swing short. Follow through 42, 43. Some bears might exit above 44, but I don't think it's that good of an idea. If you're a swing trader, it's better to wait because this is good enough for a second leg. So you might get a pullback, but we're probably still going here. 45, bad follow through for the bulls. Some bulls exit below. We get follow through 46. You can see we get to that new low on 48. So we now have a bear trend line, a break of the trend line and an attempt at a major trend reversal on 50. Even if it starts to go up, it's probably not going to be a major trend reversal. The best the bulls can hope for is probably a trading range. So the 40 low is going to be ideal because bulls bought below the 40 low and they're looking to get out around break even. So if we buy anywhere in here, probably looking to get to the 40 low and take probably 70 to 80% of your position off there when we get there. Second leg down, this is a pretty tight channel from 40 to 48, so it probably deserves a second leg down, which we get on 51. 52, you can see any bulls who bought the 50 close were disappointed in 51, and they exit around break even during 52. Bad low one short on 52, so not many sellers on 53. 54, potential major trend reversal still. And this is a small bar, so the risk is pretty small. So this is one of those trades where you kind of know it's probably going to go sideways first. So you get kind of bad follow through. A lot of scalpers on 50, 55, but buyers below 55. It's low one at the bottom of trading range, not a good sell. And then you get 56. And bulls wanted 57 to close above the breakout point and above the tight trading range. So if 57 had closed above the 55 high, I think it's more reasonable to hold. But when it doesn't, a lot of those bulls just bailed out of the trade thinking that we're going to be more sideways. And that's why you get bars like 58 sometimes, where bulls will just take their scalp up here and just get out. But 59 touches the 57 low. Bulls buy below 57, scaling lower, make money. 60, bear bar, but probably buyers below 59. And then 61, inside bar, but bulls can't get anything closing near its high or above the moving average. We get a breakout, below. It's essentially a wedge or essentially a triangle. Not really a wedge. but essentially a triangle, which is a form of a wedge. You need to break out of it on 62, 63, breakout pullback. It's just a low too short, 67, but not all that good. I still think it's going to probably be more sideways because, this is strong enough that, there's enough buying pressure in here that I think it's going to go sideways. And I think if, bars like 71 are just low probability shorts, I don't think they're normally worth taking because you're not going to get this. I think that you really get a measured move down of this starting from 71 to the end of the day in like 10 bars, like 30% of the time. So I don't think it's that worth it to sell below 71 for a swing. But some traders will and algorithms will. On the daily chart, this is a huge outside down day. And something that I've noticed is that, when we're about to go down, I don't think so. I'll start off with this. I think this was a pretty tight bull channel. And I don't think that we're just going to collapse. I think most likely bears who sell below this are going to be disappointed, and we're probably going to get back to the low of 823. So I think that this is a great bear bar, probably going to end up getting, disappointing follow through for the bears. But with that said, I do think that usually when the market's about to start to go down, the volatility increases. Now, the volatility increasing doesn't mean that the market's about to start to go down. It's just that when the market does start to go down, volatility will increase because traders are, fear is very powerful and traders will start panicking out, and that causes bigger bars, 100-point bars. We got an 80-point bar. When was the last time we had an 80-point bar anywhere in here? Maybe this, 107. Yeah. So we had big bars back here. But since this day, pretty much, we didn't have any sort of big bars. And then we have, an 80-point bar, and it's basically the top. This was 78, so that's pretty big. But, 80-point bear bar, and that's basically the top. And so this is going to be big enough for a second leg. It's a relatively tight bear channel. Low probability tomorrow we get another big bear follow through day, maybe 25% chance. We just get, big bear trend day. And if we get that, that's really bad for the bulls, and, bears might start to take over. The thing is, though, on the weekly chart, it's 4 straight bear closes, but we might have to bounce because this was a pretty tight bull channel. So I don't think we're just going to sell straight through. And this isn't the kind of price action. You shouldn't have this big tail if we're going to sell straight through. And to go a little further on the monthly chart, we have a couple of good bull closes. We might be trying to vacuum test this high. It's 42, 62.25, that high of May. I think it's reasonable to think we're going to try and test that. But if we do, I think, there should be buyers here. Most likely there will be buyers here. And if we just vacuum down to it, we're probably going to go sideways for a couple more months and then maybe form some sort of double top major trend reversal and try to get back down here. Yeah, that's today.